All right, welcome everybody. I'm Stephen Olson, the Faculty Director of the Graduate Tax Program here at Villanova University. I'm so pleased that you're all joining us for this great international tax webinar today. As you all know, Villanova is very committed to providing the highest quality education for our students, but we're also very committed to providing educational opportunities to the greater tax community. International tax is becoming, or has already become, one of, if not the most important areas of tax, and the interplay between nations is incredibly complicated. We, the grad tax program, are in the process of adding a handful of additional classes to supplement our current 2 international tax classes, and Deloitte has been great and instrumental in helping us create those classes and helping us with aspects of the new classes. We're also very thrilled that they've lent some of their expertise today to assist with the panel. Before introducing our host, I do want to say that if you love today's panel, we'll be hosting a great SALT forum on June 1st here in person at Villanova. There'll be a full day and we'll offer 4 or 5 hours of CLE CE at the same great low cost as today's webinar. So we hope that you'll come join us on June 1st for a full day of free CLE CE and a whole bunch of great tax SALT knowledge. I think Tim is going to put a link to that in our chat box as we get started here today. The admissions team would also be very unhappy with me if I did not say that fall admissions for the program are currently open. So please don't hesitate to reach out to any of us if you want to learn more about getting an LLM or MT through the Villanova Graduate Tax Program. Without further ado, it is my great pleasure to introduce our host and moderator today, Professor Mike Semes. Professor Semes has been with us for a few years here at Villanova Law. Before that, he was a partner at 2 of the Big 4 accounting firms, a partner in a national law firm. He was chief counsel for the Pennsylvania Department of Revenue. He is quite the runner, a great musician, but most importantly, he is a phenomenal tax professor and a great moderator for today's panel. So with that, Mike, I'll hand it off to you and let you introduce the rest of our esteemed panel.
Thank you very much, Stephen. And you make me laugh. And I'm wondering maybe you could come over to my house and say those things to my wife and daughters. I think I could use some of that kind of plugging, but that's very kind of you. Thank you. And I'm really, really excited that we have such a tremendous panel of experts from Deloitte with us today, as well as Madeleine Barber. Madeleine is a 3-time Villanova alum. I don't think I've ever had one of those on a panel. So Madeleine, I'm really proud to have you join us today. Madeleine has also been a tax partner at both Anderson and KPMG. She was the Senior VP of Tax and Chief Tax Officer at Tyco and is currently Deputy CFO at CBRE. So thank you very much for joining us and sharing your insights with us today, Madeleine. And we also have with us today from Deloitte, Michael Leininger. Mike leads the Deloitte International Tax Practice in Philadelphia. He is only a double Villanova alum, Villanova MBA and JD. And at Deloitte, he focuses, in addition to focusing on Pillar 2, he focuses on cross-border transactions, restructuring, and financing transactions for multinational entities. Welcome, Mike, and thanks for joining us. And finally, from Deloitte's DC, Washington National Tax Office, we have Ryan Bowen. Ryan has been spending 24/7 the last couple of years on Pillar 2. And thank you, Ryan, for joining us. And like Stephen said, international tax is very complex. It's very hot. And one of the hottest issues in international tax right now is Pillar 2. It's been going on, being discussed, debated for several years now. And the general principle is that countries, particularly countries that were not receiving income tax revenue from large multinational entities because of the way they transacted business in the digital economy, we're saying, wait a minute, we need to level the playing field here. We need to get some more tax revenue. And I'm putting that in very, kind of coarse terms. But there was a perception that they weren't getting enough revenue while the digital economy was exploding. And as we know, the OECD is a group of about 38 countries. And like I said, for the last several years, they've been debating this, Pillar 1 and Pillar 2. We're just going to be talking about Pillar 2 today. And we're going to talk primarily about three things. The first is how we got to where we are. What was the road that Pillar 2 took? And then we're going to talk about how it works. And then finally, how it impacts our clients. And with that, and right before I turn it over to Mike Leininger, there are two words that you need to know to get your CPE credit. I will give you the first one now. Many of you probably guessed it, that it is wildcats. So the first CPE word is wildcats. Mike.
All right. And thank you, Mike.
And actually, you know, Mike, maybe I can even just tee you up just a little bit. I think you're going to start off by talking to us about the road to implementation of Pillar 2.
Yeah, and I can go through a little bit here in terms of how it works, just to level set. But I guess first and foremost, thank you, Mike, and thanks to Villanova for having us. And I think just in sequence, Ryan, maybe you want to chime in here on the road, and then I can get into some of the details here in terms of the mechanics and how it works.
Sure. So as Mike kind of laid out, this all kicked off several years ago with a focus on digital economy and the perception that countries either weren't collecting their fair share of revenue or that certain companies weren't paying enough tax overall. And Pillar 2, I think, really focuses on that second point of an overall tax burden being borne by the largest multinationals. So the OECD inclusive framework, which is, I think, 137 countries beyond just the 37 or so that are in the formal OECD itself, all agreed on this idea of a minimum level of taxation in each jurisdiction around the world in which a multinational enterprise operates, which was something that was really unheard of, I think, in international taxation, that you could get so many countries agreeing to this minimum level of tax and a framework in which to implement that level of taxation. So that process went on, I think, in fits and starts for several years, but really culminated in December of 2021 when the OECD released these model rules. And what we'll talk about today, and I think Mike's going to touch on in terms of operation, is really focused on these model rules, because at the end of the day, the intent is that countries around the world will adopt legislation implementing these Pillar 2 rules in a consistent fashion. And it's all going to be based on these model rules and subsequent guidance that the OECD puts out. And I think we'll touch on how realistic is it that those rules will be implemented uniformly around the world, but that's the premise. So again, that was December 2021. We've had some further guidance from the OECD since then. But one lingering question following the model rules is anybody actually going to do this? Okay, we have this draft legislation or framework that countries can apply, but is anybody really going to take the step forward and adopt these measures? And especially in the US, I think there's a lot of hesitancy among both tax professionals and multinationals to really start thinking about how these rules might impact them, because there was a sense that they probably would never come to fruition, especially if you look at what happened here in the US with Build Back Better and our attempt to adopt these rules kind of floundering. But I think that has since shifted following in December last year, December 2022, when the European Union adopted a directive that requires EU member states to adopt these Pillar 2 rules. And so that was sort of the critical mass, if you will, of countries that will have to adopt these rules. And as Mike talks about the mechanics, you'll see why once enough countries start to adopt these rules, it really puts pressure on other countries to go along with adoption as well in order to capture that revenue that's going to be collected somewhere. So again, once the EU adopted, we started to see other countries announce either draft legislation or at least some formal commitment to adopting these rules as well, even outside the EU. And in particular, even in traditionally low tax countries like Switzerland, Hong Kong, Singapore, all announcing some intent to adopt these rules, at least in part, in the near future. And so that's kind of where we are today, is countries certainly in the EU, but also outside the EU, starting to put forth proposals, draft legislation, the like, with the goal of applying these rules starting in 2024 and onward.
Yeah, and I agree, Ryan, that December 22 was really the turning point at least in the US, my client base, I think a lot of folks didn't think it would happen. And once it became pretty clear that it would, people went home for the holidays, got through year end, and now this is it. I mean, this is what everyone's focused on right now. And this global minimum tax that Mike and Ryan mentioned, really what you're doing is it's a top up to this global minimum tax of 15%. And that's calculated on a country by country basis. So it's not based on the specific entities, it's country by country. So if you have multiple entities, and it's not just entity in the traditional sense of a corp, we'll talk about that a bit later, but permanent establishments and a broader entity definition. A constituent entity is the defined term of the statute. In terms of who's in, it's relatively broad. It's anyone with annual consolidated group revenue. This is their multinational group of 750 million euro or better. That test, you look to the 4 immediately preceding years, and if they're over that in 2 of them, they're in. There's certain other exclusions that I'm not going to spend time on: pension funds, government entities, nonprofits, a handful of others that aren't in this. But for most of your big companies out there, most of your big multinationals, this is a big deal. This is here and this is real. So what is this top-up tax that we're talking about? Really what we're doing is we're taking on one hand this 15% minimum tax rate, and we're comparing it to the ETR for the jurisdiction. And what's the ETR for the jurisdiction? Well, I think in the most basic sense, it's tax over your income that you earn, your pre-tax income. And that sounds easy, but as we'll talk about later on, what constitutes the tax that goes in that numerator and the income that goes in that denominator can be very tricky in terms of the adjustments that you need to make and a number of the things that you need to factor in. So that's kind of the name of the game, is first getting the ETR by country and comparing it to that 15% minimum tax. Once you do that, you take the top up percentage and you apply it to the Pillar 2 or the globe income in that jurisdiction. After you deduct what's called the substance-based income exclusion. And effectively what they're doing there is the rules are giving you a percentage markup. I won't go into the detail, but a percentage markup on your tangible assets and payroll costs, that you get a benefit for that to the extent that you've got a lot of substance in a particular country. So that's the top-up mechanism. But how's the liability for the top-up tax? How does that arise? And I don't know, Mike, if you can put up that.
I was just going to ask you whether you'd like me to put that slide up there.
Perfect timing. So there's really 2 rules. There's a main rule and a backstop, and then I'll talk about the final piece of this. But the main rule is this income inclusion rule. And this is paid at the level of a parent entity in proportion to its ownership in entities that have low taxed income. So generally, you look at this income inclusion rule or this IIR, you apply that at the top, generally at the level of the ultimate parent entity, and you work your way down the ownership chain. So you can almost look at this as if it's an income inclusion rule. It results in this tax payable at the highest tier entity within your structure that's enacted an IIR. So I'll do an example of that in a minute so that it makes a little bit more sense. But the second aspect of the rule, this backstop, let's just say you don't have an IIR that applies, so that this is imposed to prevent leakage, that this backstop is there, and it's imposed on undertaxed income when the parent country fails to adopt a qualifying IIR. And I guess it can also apply when income in the parent jurisdiction is low tax. But generally think of this as where there's no IIR, you've got this UTPR, this undertaxed profits rule as the backstop. And the share of the top up under the undertaxed profit rule, that's calculated formulaically, and I'll talk about that in a minute. And that's in proportion to your relative share of the assets and employees that you have throughout the world. So look at this as lots of different jurisdictions can come in here and tax with respect to the UTPR under this backstop rule. And the final piece of this, I don't want to spend a ton of time, but I know there's lots of students, maybe other folks on here who don't have the background, so I do want to spend a minute. The QDMTT, the Qualified Domestic Minimum Top-Up Tax, is a huge point here. because a lot of countries said if they're in a lower tax jurisdiction, the government said, hey, wait a minute, if somebody else is going to tax this profit, then why wouldn't I do it? So local countries have this option that they can impose this qualified domestic minimum tax and tax the income itself. And to the extent that a QTMTT applies, those taxes directly reduce any top-up taxes that would be imposed under the main rule or the backstop rule. So that's like the first priority goes to the country to tax their own income, which makes a lot of sense, and it's consistent really with how we look at things. Maybe if we click to the next slide, I could do just a quick example, Mike, and we'll move on here. So here you can see an example where we have parent country, it's parent company in country A for the year. Apart from anything Pillar 2 related, it had a $50 loss. It didn't pay any tax. And then you look at each of the subs. You've got sub 1 in country B, had 100 of income and 20 of tax. So that had a 20% ETR. They're okay. Country C branch had 50 of income and 5 of tax. So they're only at 10%. And you may say that's a branch. Does that count? Yes. For this purpose, you treat it just like a corp. So it's a 10% effective rate. And then you look at Haven Co. and they haven't paid any tax at all. So the top up here with respect to country C and Haven Co. is a tax at the country A parent co under the IIR. And the $50 loss there is actually not relevant. It's almost shown to illustrate that point that this top up is independent and exclusive of anything else that's happening under the normal tax rules of that parent country A. So the top up here on Haven Co. and country X and country C, that amount is the top up under the IIR, regardless of whether there's a loss at the parent co. And then if we go one more slide to the UTPR basics, let's just say here your parent company didn't adopt an IIR, situation where there's no IIR in the parent co, and let's just say Haven Co. hasn't either. So Haven Co. and country X, again, 70 of income, they don't pay any tax. Well, who taxes here? We've got this minimum tax concept. I don't have an IIR. How does this work? Well, in this particular case, the UTPR, the backstop rule kicks in, and it's at sub 1 and sub 2. And effectively what you do is look at the ratio of employees. So at sub 1, it's 50 over 80 for employees and 1,200 over 2,700 for tangible assets. You get your percentage. And then on that 10.5 of tax, 15% of 70, each of those respective subs under the UTPR gets that tax is allocated to those entities under the UTPR. So that's the mechanism. And I don't want to go into too much more. We're going to talk about a ton today. There's a de minimis rule. We'll talk about that later. If there's less than 10 million euro and of revenue and less than $1 million in profit in the country, you can get out there. We'll talk a little bit more about that. But that's the lay of the land. And sorry if I went a bit long, but I know that's just really the important fundamental stuff for any of this to make sense.
Well, Mike, I got to tell you that I try every night when I say my prayers to kneel down and say, thank God for international tax people who can understand this alphabet soup and all these complexities.
It's a lot.
As a state and local guy, I just couldn't do it. So that was really helpful background. I'm sort of at least kind of understanding a little bit of it. But one of the terms you had mentioned was globe income. And that's capital G, capital L, little k, lowercase o, capital B, capital E. And, Madeleine, maybe you could help us out and tell us something about that and how that fits into the equation, even though that wasn't the IIR or UTPR or QDMTT. Yet another term here that's relevant in the formula.
Yes, sure, Mike. Thank you. And yes, there are a lot of acronyms and abbreviations in the model rules and the commentary. So it can be a little bit overwhelming. But basically picking up on what Mike just said. So the theme here is that there is a level of minimum tax that the countries around the world who are part of the framework have agreed companies, enterprises should pay. So to determine that level of tax or that effective tax rate, in order to determine whether or not an IRR or UPTR kicks in, or the qualified domestic minimum tax rules kick in, you have to start with a tax base. And that's where the GLOBE rules come in. So essentially what the framework tries to do is start with your financial accounting income. So unfortunately, this means we're now going to have another set of books. So it's this hybrid concept again between book income or financial accounting book income and taxable income. So the starting point for each constituent entity is financial accounting books that are maintained according to an agreed or an accepted international or national accounting standard. And they have to be the books that are maintained in accordance with the accounting standard that the consolidated books are prepared off of for the MNE. Now, if there are some rules that apply when the constituent entity doesn't follow the same accounting method as the consolidation. But in general, you're really going to start with those same financial statements that are prepared. For example, for a US MNC, you're going to start with the books that are prepared under US GAAP. And then you have to make certain adjustments. So you're starting with net book income. So it's the bottom line net profit or loss determined under the financial accounting rules. You then have to make certain adjustments. So it is pre-consolidation. So any intragroup transactions that happen between members of the group, they are not eliminated at this stage. So you keep the single or standalone entities, the effects of those transactions, which the rules say have to be maintained or recorded at the same price under the arm's length standards. There's a separate set of rules that talk about and go into detail about how these intragroup transactions have to be recorded for these purposes. You then have to look at whether or not there are consolidating entries that are recorded, quote, topside or at the consolidated level, with the exception of purchase accounting adjustments. So any adjustments that are specifically traceable to a constituent entity, you are allowed to push those down in effect to those entities so long as they can be reliably and consistently traced. So there is no allocation of topside entries. You then have to take into account whether or not there were any items of income or expense recorded through what's called other comprehensive income in the financial statements, or OCI, if you're familiar with that term. And that's a section or part of the financials where certain adjustments such as equity gains or losses or revaluation, impairments, things like that are taken into account and recorded for financial statement purposes. In most cases, those items are going to be excluded from GLOBE income. But one of the themes that you have to keep in mind, we'll talk a little bit about cover taxes, is that there's a correlative or symbiotic relationship between items of income and expense that are included or adjusted for in determining your GLOBE income and whether or not taxes, current or deferred taxes, were recorded with respect to those items of income or expense. So if it's in for GLOBE purposes, then you may have to ensure it's in for cover taxes unless there's a specific exception or exclusion. If it's not in GLOBE and you have recorded taxes or items of tax expense related to that, you have to adjust for that to back it out so you have some consistency. Then you have specific adjustments in order to try to eliminate the issue of timing or temporary differences between book and tax. And this is important, as we know, in order to ensure that the policy objectives behind all of this are achieved and to try to eliminate some of the volatility that can occur between what you do for book purposes and what you do for local tax purposes. So types of adjustments that you have to think about, and there are a lot, are your net tax expense. And we're going to talk about that in a minute when we define covered taxes. Excluded dividends, excluded equity gains or losses, losses from the disposition of assets and liabilities in the cases of certain restructurings and reorganizations. And there's a whole section I believe it's Article 6, but don't quote me on that, in the model rules that deal with the impact of reorganizations and restructurings and how you have to deal with that in determining the globe consequences. You also adjust for foreign currency gains or losses, other policy disallowed expenses such as bribes and penalties, prior period errors or adjustments that may occur or be reflected in the financial statements, and then accrued pension expense. There is an election with respect to stock compensation or stock-based compensation. So a company or an entity can elect on a jurisdiction by jurisdiction basis to exclude, or sorry, to utilize the amount of expense that's recorded for purposes of the financial accounting for the financial accounts, as opposed to the tax amount. And a couple of other points with respect to one, minority interest. So for example, if a constituent entity within the group is owned by a minority stakeholder, you don't adjust the globe income to reflect the minority interest. You look at it at 100%. That minority interest is going to be taken into account when we calculate cover taxes and allocate the UPTR or any of the other top-up taxes that may come into play. And then, as I mentioned, the interplay between members of the group all have to be recorded using an arm's length standard and essentially using the same price. So let me just talk briefly, I don't want to go over my time, regarding covered taxes. This is, again, another term that is defined, and the rules talk about which type of taxes are included in covered taxes. But for purposes of determining the effective tax rate that you have to test against the minimum standard, we're really talking about another defined term called adjusted covered taxes. The rules go through a series of complex adjustments, particularly because you have to back out your deferred tax expense. You start with the current tax expense, but then you have to go through adjustments related to your deferred tax accounts. The safe harbor rules, which Mike is going to talk about in a few minutes, give some relief for how you deal with this, particularly in the transition year, and whether or not a company or an M&E or an entity rather is eligible for one of the safe harbor simplified methods. So you don't have to go through all of this for the safe harbor years. But essentially, you're going through a process of having to look at all your deferreds and first off, recasting them. If they are booked at a rate in excess of 15%, you have to recast those deferred tax attributes at 15%. If the deferred assets are calculated at a lower rate, you can top up to 15%. Valuation allowances are reversed. Certain tax credits and amounts recorded on uncertain tax positions have to be removed. And then you have another complex set of rules that talk about deferred tax liabilities that won't reverse within 5 years. And again, there are exceptions that apply. A lot of complexity here. I can't emphasize enough. Article 4, which deals with all of these covered taxes rules, can be extremely complex. The one thing to keep in mind as you think about what's going to be required, we'll talk about the implications, is that you're going to need to potentially maintain and look at particularly deferred tax liabilities because of this 5-year rule. If it comes into play or is applicable, you have to keep account of everything on an item by item basis. So that's another level of complexity that will have to be considered as you work through these rules.
Madeleine, that was extremely helpful. Thank you. That was a lot. And I think it probably makes sense to point out that these rules, these model rules, are about 45 pages, and there are 15 pages in addition of definitions. And so you're just going through some of.
Well, then they have 228 pages of commentary, 24 pages of examples, and then which came out with administrative guidance, and then the transition rule. So yes, there's a lot.
Yeah, they just want to, they don't want the Internal Revenue Code and regs to be bigger. They want
No.
to that. So maybe we can go back to one of the things that Mike Leininger had mentioned. And on his slide, he said, this I think it was sub 2 was a branch. And you said, well, that's really treated as a corporation. Ryan, going to another definition, constituent entity. Could you tell us, maybe bring us back to something a little bit simpler, and then we can get into complex and messy things later. But talk to us about how branches are treated.
Sure. So, like you said, Mike mentioned this in the example, we have that branch there and said it was treated as a constituent entity. The import of that is that if you think of all these rules really trying to assess whether you're sufficiently taxed in each jurisdiction, you need to take into account branches that are operated outside of the jurisdiction in which an entity is incorporated. And so the Pillar 2 rules include in their constituent entity definition a permanent establishment, which is treated more or less the same as an incorporated entity. There are some special rules that apply. But I think the more interesting issue there is that the definition of permanent establishment for these purposes is pretty broad and goes beyond what some of us might traditionally think of as a permanent establishment under, say, a treaty or a U.S. trade or business that's subject to tax on ECI principles. It certainly includes those things, but it also includes these deemed PE definitions for instances where, say, a country doesn't have an income tax system, and so it doesn't have a treaty, it doesn't have sort of net basis taxation that would apply to companies operating in that space. In certain cases, the rules will deem a PE to exist there. And also, very importantly, and there's a lot of complexity here, which we probably won't get into, but there's this concept in the rules of a stateless PE. So if you have, say, operations in a jurisdiction that aren't subject to tax locally because they say don't tax offshore income, but at the same time aren't taxed in the main entity, the branch owner's jurisdiction, that creates this stateless PE under the Pillar 2 rules, and that's subject to all sorts of special rules that apply, but ultimately end up with a situation where you have almost per se top-up tax on that stateless PE because it's effectively not subject to tax anywhere. And so that's a concept I think is very interesting in these rules. And in some cases, especially for clients who have certain structures, can be very problematic because they have, say, a maquila structure, for example, where that PE is not subject to tax, for example, and now suddenly it falls within the stateless category under the Pillar 2 rules, and that creates a host of issues. The other thing to mention with constituent entities is a flow-through entity. And obviously in the US with our check the box rules, our concept of what's a flow-through entity in certain situations differs from, I think, what the local country might see or what other countries typically do. But there are a host of rules that apply to flow-through entities and how you allocate the income out. Again, we're trying to figure out what's the appropriate jurisdiction for the income that's earned by that flow-through entity. In some cases, that flow-through might be deemed to operate a PE, even in its own jurisdiction. And so that might be the appropriate situs for that income. But in other cases, maybe we should allocate the income and the taxes associated with it out to the partners in the partnership, for example. And so again, there's special rules that apply there, rules that apply for hybrid scenarios. And so I think one of the big complications we've seen for the US tax community is how we think about our check the box entities, how we think about partnerships, hybrid partnerships. Under these rules, it's very different than how we might look at it from a US taxing lens. And so there's a lot of complication that's arisen there. And that we've had to talk to our clients and work through some of the issues that can arise in that space.
Oh, sorry, I couldn't get my mute off there. Yeah, no, that's helpful, Ryan. And Mike, I don't know where you think we should go next because of timing. I know that there are some things that you wanted to talk about, like maybe the interplay between guilty and Pillar 2, and some, how the Inflation Reduction Act may impact or may not impact refundable credits. And how some of those things play together. So I don't know, where do you think would make sense to go next?
Maybe I could just touch briefly on two topics. One is the guilty point you made, Mike, because I think it's a really big one. A lot of people have been waiting for that news, which we got back in February. on guilty. And then I think only because it's top of mind for so many clients, I'll just at least briefly mention these safe harbors that exist. I'm not going to go through them all. There's one that's a de minimis standard. I mentioned that a bit earlier on. There's a routine profits test, and that's really this same. I referenced it a bit in the intro. You compare your pre-tax profits in a country to this substance-based exclusion amount. So there you take 10% of your in-country employee payroll costs and 8% of your in-country tangible property, and you compare that to your pre-tax profit. And if it's equal to or less than, your pre-tax profits are less than, then you're out in that regard. So there's sort of those two outs there with respect to the safe harbors. But the big one, Mike, that everybody is really, I think, most focused on is this effective tax rate test. Because people said, all this complexity, everything Madeleine spoke of, everything we've been going through today, that's just unduly burdensome for companies that are just operating in high tax jurisdictions. It's just way too much, and there's got to be a break. So at least what we got for now is transitional safe harbors, maybe permanent at some point, but transitional safe harbors. So if you're a taxpayer, calendar year taxpayer, we're talking about 2024, 25, and 26. We have these safe harbors, but effectively what this effective tax rate test is they allow you to calculate a simplified ETR, and effectively all you do is you take your, I don't want to say all you do, there's a bit more to it, but you take your tax expense per the financial statement subject to certain adjustments, and that's your numerator, and you divide that by your income by jurisdiction based on your qualified country by country reporting. So it's tax return, taxes over country by country report income. And there's a little bit more nuance to it, but effectively it's much easier than a full-blown globe cap computation. You come up with a simplified ETR, and you compare that to what they call the transition rate. And for 23 and 24, the transition rate's 15%. For 25, it goes to 16. And for 26, it goes to 17. So for a whole lot of companies out there, this isn't all or nothing. This isn't like, look, all of your subsidiaries are in or out. You can have situations where you'll have a mix of countries. Some will meet the safe harbor and some won't. But this is a lot of what you see clients out there working through right now. And it may not be as easy as it sounds, because with the country by country reporting, sometimes you have things that could increase income. Maybe there's some double counting of income. For the taxes, maybe there's some covered taxes that aren't in your financial statement. So it's not always going to give you the best answer, but at the same time, if you can get there under the safe harbors, it's the place to start. It's the easiest way to get through this stuff. So that's my quick couple of thoughts on the safe harbors, and it really is where I think I see most of my clients focused here, at least to step one. And then on the guilty point, this was a huge one. And back in February, we got some guidance here in terms of how that works, because guilty, we have a lack of conformity there, that guilty's not country by country, guilty's not a 15% rate, but nonetheless, back in February of this year, the OECD released implementation guidance considering guilty a qualifying CFC tax. And effectively, the way this works is if you look at any CFC tax, the rules here for purposes of Pillar 2 for your globe calculation actually take the tax that's imposed on the shareholder under their CFC regime, and they push that tax down to the foreign entity where the underlying income was generated. And it's that underlying entity that gets credit for those taxes when you're looking at their ETR. So here we are in the US with guilty. How does that work? Well, what the rules tell us is you look at all of your guilty costs. So you look at it at all in your total US tax liability for guilty. So you take into account your Section 250 deduction. You take into account your foreign tax credits with the 20% haircut on foreign tax credits. Maybe the big one, you take all of your cost of Section 861 expense allocation, and you look at all those costs, and effectively what you do is you push down to the foreign entity, to the CFC that generates those underlying foreign earnings. And in a way, the way these rules came out, they actually came out to be pretty taxpayer favorable, because it's not sort of this just spread the cost. effectively through this allocation key, which we don't have time to get into, the rules tell you to allocate the guilty costs to the jurisdictions with the lowest effective rate. So it's actually quite helpful in that regard. Unfortunately, just a couple points, not here to stay. This is scheduled to sunset and be revisited in 2027. I guess the idea at that point is maybe the US, who hasn't adopted Pillar 2, comes along with an IIR or does something more, but this isn't permanent. And another big thing, because I mentioned QDMTTs, this is huge for a lot of clients out there. When you look at whether you've got a stateless entity or you're got a constituent entity in a specific state with a QDMTT, if you have a QDMTT, you don't get to push down guilty taxes. So that is a huge point. So Ryan mentioned stateless. So if it's stateless, there's certain disadvantages to being stateless, but you could at least push down the guilty taxes. If it's a constituent entity where a QDMTT is imposed, that's it. There's no opportunity to push down the guilty cost. So I went a little quickly, but they're kind of two big points I thought we should hit.
No, that's great. And I think, you're doing your own kind of inclusive framework here for, for us to understand the framework. But so Madeleine, we've talked, there are 38, 40 countries in the OECD. There are another 138, 140, whatever, who are in this inclusive framework. So even though these model rules have come out, it's kind of like the state analog to the multi-state tax commissioner or uniform law committee. So they have these rules, but then isn't it up to every country now to adopt these rules and pass it through their respective legislative bodies? And if so, couldn't we have dozens of different variations on this? And how does that work? And how do taxpayers deal with that kind of complexity?
Yeah, you're right, Mike. That is the issue. There's the Pillar 2 rules are going to essentially really are a game changer. The complexity and the novelty of the rules certainly add to the current existing compliance burden and regulatory burdens that multinationals operate under today. And so, like Ryan mentioned, we have the EU directive, which, under that, we expect the EU countries to adopt or enact the legislation by the end of 2024. If South Korea, that's put forth its rules. The UK, which actually has probably did the best job in terms of negotiating the ability to keep certain benefits, investment credits available to offset. And then you've got the big economies of the US, China, India that have not really signaled. And Ryan, you correct me if I'm wrong here, or you have any more current information. They haven't really signaled an intent to move forward. And as you think about the US and the current political environment, it's not likely that we're going to move forward anytime soon. So what does that mean? Well, first, there are obviously concerns I have, and Mike alluded to this, with the notion of the QDMTT. So if you think about an ordering rule, who gets first bite at the apple? Well, the way that the model rules are written, they actually incentivize countries to adopt a QDMTT, because if you do that, you take priority. And as Mike said, if you have you're in a jurisdiction like the US where you have this blended CFC tax regime, as they call it, you're not going to get any relief or offset against a QDMTT tax that a jurisdiction could impose first. And so then the next tier down, or the next one in line, is a qualified IRR, and then you have the backstop of the UPTR. So you in a sense have, before we had this race to the bottom, which is what the OECD was trying to get around, stop. Now I call it the race to the top up tax, right? Who's going to get the top up tax first? If the United States, given our system, doesn't make a change to our 901 tax credit, foreign tax credit rules, we're going to have US MNCs effectively double taxed. if you're paying tax in a jurisdiction or fall under the rules in a jurisdiction that has a qualified domestic minimum tax. We have to see what happens. Is there going to be a multilateral instrument that's going to help navigate the administrative elements of this? The OECD is going to release more guidance, as countries adopt. So we have more uncertainty in what's going to come forth from that. Conflict resolution, the status of this under current treaties, and frankly, the ability to politicize this, right? I mean, there's already retaliatory measures that have been put in place, prior administrations and whatnot when it comes to imposing tariffs. So what's going to happen if one country, is taxing, and in the example that Mike put forth, you have two countries taxing, although there are some mechanisms that you can look at in your structure to try to, position so you have a more of a top-down approach as to who might tax. So there's a lot of unanswered questions, on top of which the complexity of this. And my advice, and I think, Mike and the team from Deloitte are probably better at talking about this, is the type of modeling and just computation engines that you're going to need to be able to do this, even with a safe harbor, because you first have to figure out whether or not you're entitled or qualified to use a safe harbor. So the amount of data and then the amount of iterative modeling processes that can be reconfigured as these laws are adopted around the world by each country, and then changes occur. It's going to take a lot of technology to be able to handle this. And then my last comment is, don't underestimate the impact that this could have, on your financial statement. So the FASB staff came out recently, based on the model rules, indicating that the minimum tax essentially should be treated as an alternative minimum tax. And so you don't have to account for this in your current, in deferred, or put up deferred tax attributes with respect to this. It's going to be treated, again, assuming these rules are adopted consistent to the model rules, it'll be a period cost. Well, while that gives the tax team relief in terms of having to deal with deferred tax calculations, the last thing CFOs and CEOs want to have is uncertainty. And so you have to have all this data and continual modeling to be able to anticipate when these period costs may hit. So Mike, I don't know if you have any other comments.
No, I think you hit the nail on the head. I think your point on a U.S. foreign tax credit for QDMTTs is going to be really, really huge, because as you see more and more countries go down this path of the QDMTT, which I think they will, if we're not able to credit QDMTTs here in the U.S., I think we're actually getting to a somewhat unintended answer there, Madeleine, as you alluded to. And I think your other point around the technology and the data needs, this is like nothing we've never really encountered anything like this in terms of the unique data that's this blend between tax and financial accounting, some of the tracking mechanisms that you wouldn't track for any other reason, different sets of books. I mean, just really not something where you sit down and you say, hey, tax laws change all the time. I'll just sit down and create my spreadsheet and, do it as I normally would. This is just a different animal. It's just entirely different in terms of how you look at it. Even the people that do the work we see in terms of who the folks we're hiring and the way we're training, it's just a different skill set. It's really unique. And I think my message is consistent with yours. Don't wait. This stuff's a lot trickier, I think, even than it appears when you dig in and get into the weeds. I don't know, Ryan, if there's other thoughts.
Yeah, excuse me, but before Ryan jumps in there, let me jump in and let our audience know that the second CPE word is Villanova. So the second CPE word is Villanova. So I'm sorry to interrupt there, Ryan, but Mike had asked you.
Yeah, no problem. I just to echo everything Mike and Madeline already said, I think, especially with the point we led with at the beginning here, that the US clients were a little slow to come to the realization that this was happening, now puts everyone in sort of a rushed um, phase of trying to get ready. And so modeling super important. And I stress that in particular when I talk to clients, because they want to know, what should we do? Where are our problems? And those questions are impossible to answer without running through the modeling and seeing where you have some stress under the system, because these are brand new calculations and it'll take a lot of data that folks don't have today. And so it's really hard to go in and say, on like a back of the envelope calculation, well, I think you need to do this, or I think you might have an issue here. Because once we get into the numbers and run it through the calcs, sometimes it teases out some unexpected results. So I think coming to terms with data and modeling is probably first and foremost for almost any client.
Yeah, and Ryan, that reminds me, my wife sold real estate to put me through law school, and her motto, and everybody I think in real estates was, location, location, location are the three most important things. And I think in any kind of tax world, especially new world like this, three most important things are model, model, model.
Yes.
I also envy the people who, I benefited going through school right after the 86 Act was enacted. So I was basically on a level playing field with people who'd been practicing so much longer. And and like you said, Mike, the students who are coming in now, and they're hitting the ground running at the same speed that people who have been practicing 10, 20, 30 years. So they have a bit of an advantage.
Yeah.
It creates an unbelievable opportunity for folks who are new to the profession. I mean, it's no longer the person who's been 30 years doing this, because that person, we all heard about IIR and UTPR just recently at the same time. So we were seeing a lot of our more junior, newer folks being very consultative early on in their careers and really making a big impact.
Yeah. And one thing probably of note, sorry for
Please go.
This audience, my background, I'm an attorney, I'm not a CPA, and the amount of accounting I've had to learn as part of the process is just overwhelming. And so I do think there's a new skill set there as well for all the lawyers out there to at least gain some familiarity with accounting concepts. And the sooner you can do that, the better. And obviously, like I said, it'll give you a big leg up over the folks who've been doing this a long time and don't really want to go back and learn ASC 740 at a late stage in their careers. So.
And thank you, Ryan, for that very subtle plug that Villanova offers an LLM and an MT. So we we have accountants and lawyers in the same classes. And I wouldn't be surprised if, given Pillar 2 and other events in the international space, that we start offering more courses in this area. So I think it would be a good idea.
Yeah, absolutely.
Oh yeah, and to the panel, one of the audience members, actually a former student of mine, asked, do we have any sense for the likelihood of the safe harbors becoming permanent?
Well, I think, and Ryan, maybe I'll kick that to you, but I think one of them, in effect, sort of is the de minimis test. I think under the transition period, you do that with your country by country report, and you'll still have the de minimis test going forward, but you're going to have to use your more complex globe calculation. But for your smaller countries, that revenue of 10 million euro, $1 million of profit, you'll still have that out. But then just overall on the notion of permanence, which I know we're trying to get to, maybe I'll turn that to you, Ryan.
Yeah, I don't think that especially the simplified ETR safe harbor, and again, this is almost pure speculation / rumors, but I don't feel like the simplified ETR safe harbor is here to stay. I think where we've seen the most chatter on permanent safe harbors is the idea, if you have a QDMDT, the local top-up tax, that you don't have to then also submit all the information all over again for the IIR UTPR purposes, and instead it almost becomes like a checkbox on your globe information return that says QDMTT applies, no further work needed. That seems like the most likely outcome, which unfortunately is not going to, it'll be helpful in terms of compliance, and that you don't have to report in 2 different places, but it won't simplify ultimately the data and the calculations and things like that that clients will have to do once those other safe harbors start to roll off in 27.
No, and I think that's great. So maybe we can kind of wrap things up here by asking each of the 3 panelists for your insights and points of view on any other specific items and things in addition to modeling that taxpayers, clients, practitioners can do to prepare for this tsunami of uncertainty that, that we're currently experiencing or going to be experiencing very soon when these rules go into effect. Madeleine, why don't I start with you?
Yeah, sure. I guess one, if for those who are perhaps practicing in the corporate environment is early engagement, early and often with your colleagues cross-functionally, particularly make friends with folks in the IT groups. We talk about modeling and the type of data that you're going to need. I also make sure that the C-suite and audit committees are kept up to date on these changes. I think one other comment or thought, it always really helps, I think, to play both offense and defense, right? So offense, we talked about, that's the modeling and looking at how, starting to think about how this is going to potentially impact and dig into the rules, because there are a lot of areas that are uncertain and unclear. And until you model, you may not have a feel for where those results might impact you or your company. On the defense side, I would say, for those of you who follow this, maybe aware Manal Corwin, will be taking over as head of the OECD tax staff from Pascal. And Manal comes from an illustrious background out of Treasury and National Office KPMG, and obviously a US-based tax expert. So, the ability to interact with the OECD, some of the comments again that Ryan was mentioning about the safe harbors and the complexities. I think it's important that companies take affirmative action to perhaps engage with the staff and talk about some areas that they may not be aware of to help the OECD as they release further guidance.
No, I think that's very spot on advice. And wish my clients over the years had paid attention to that kind of advice. Thank you, Madeleine, and thank you very much, Madeleine, for sharing your insights today. Ryan, what are your parting thoughts?
Yeah, I think that's a great point, Madeleine brought on there. And I guess just to piggyback on that, you can't start any of this too soon, right? The first globe information return, I think, is due in 2026, but clients have to get ready for provision in Q1 of 2024. And so starting all this as soon as possible is really key. I think even if you're not doing everything all at once, you can start to get ready, assess, weak spots in data, determine who's going to be responsible for which functions within the company, just to get the ball rolling, because I think we don't want to end up in a situation, right, where it's March of 2024 and you're just now starting to get these processes and this data put in place. And so the sooner the better is really my message to folks going forward on all this.
No, I think that's great advice, Ryan. And like you, I'm only a lawyer. I'm not an accountant, but having spent over 15 years in Big Four firms, I think that I'm kind of comfortable now playing one on TV. That's about as far as I go. Michael, your last thoughts.
Yeah, and it's funny that the 2 thoughts I had, Madeleine and Ryan, them both. So they're big points. The only thing I would say, we didn't have time to do it, and honestly, it was beyond the scope. It's a discussion, it's a course in and of itself, but there's transition rules, and to the extent people are doing transactions today, or really a lot of the stuff that you might be doing in the ordinary course of just running a tax department and planning and whatever else that is that you might address, the stuff you're doing today matters. It counts. We're in this transition period, so you really have to be mindful about some of the Pillar 2 impacts of transactions you're undertaking today, notwithstanding the fact that we don't actually have IIRs or UTPRs in place until 24 and 25. What you do today does matter, so don't lose sight of the transition rules.
Well, thank you, everybody. We're lucky to have friends like you sharing these kinds of insights. I said it before and I'll say it again, I would not be surprised. In fact, I'm sure we're going to be seeing more international tax courses and look forward to partnering with people like yourselves to form those courses and get them out to people who can really benefit from them. A really, really important topic. And, you know, the graduate tax program thanks all of you, your respective organizations. We look forward to continuing this kind of dialogue and this kind of educational outreach in the future. So with that, I will conclude. Again, thank you, everybody, and have a great day.
Great. Thank you for having
Thank
us. We appreciate it. Pleasure to be here. Thank you.
you.